Hi, my name is Amit, and I am the operations manager at Fleet Spark. This is video 19 in our Trucking 101 series. In the previous video, we defined your floor rate and showed how to calculate your cost per mile so you can price loads above break-even. In this video, we are building on that foundation. Pricing loads correctly is essential to succeeding as an owner-operator, but understanding what we call the cash flow gap is just as critical. Here's what that means. Even if you price a load above break-even and deliver it successfully, you don't get that money right away. You may wait 30, 60, or even 90 days to get paid while the fuel, tolls, maintenance, insurance, and wages were already paid out of your account. That time gap between spending your cash to operate and being reimbursed for the work is what we call the cash flow gap. In trucking, this gap is built into how the business works. You pay for fuel, tolls, maintenance, insurance, and driver pay up front out of your own cash. Then you deliver the load and submit the required paperwork. After that, the broker typically has 30 to 90 days to pay you. So you can end up waiting weeks or even up to 3 months to get reimbursed for money you already spent to complete the work. For example, if you run a 1,000-mile load and your operating cost averages about $2.26 per mile, you're spending roughly $2,260 out of pocket before the invoice is even submitted to the broker. That's what creates the imbalance. Your expenses happen immediately and on schedule, but your revenue shows up later, and it depends on paperwork being accepted, processing time, and the broker's payment cycle. This is where pricing and cash flow connect. Pricing protects your margin, but margin alone doesn't protect your cash position. You also have to plan for liquidity. A carrier can run loads above break-even and still fail if there isn't enough working capital to survive the 60-day gap between expense and payment. Working capital is simply the liquid cash you can use to keep operating while you wait to get paid. Without it, even a profitable operation can run out of cash and the truck stops moving. That's why cash reserves matter. In 2026, many experienced operators suggest that $20,000 to $30,000 in liquid reserves is a realistic minimum safety net for a new authority. Some carriers reduce the cash flow gap by selling unpaid invoices to a factor for a fee. We introduced freight factoring in video 16 as a way to get paid faster by turning invoices into cash. And in video 17, we explained why the contract terms and fees matter. Others use broker quick pay, where a broker offers earlier payment in exchange for a fee. Both options can shorten the payment gap, but they do not change your underlying cost structure. You still have to pay for fuel, insurance, maintenance, and other operating expenses up front. You also need enough reserves to keep the business moving while you wait to receive payment. This is one of the main reasons many new owner-operators fail within the first 2 years. It is not always because they cannot find freight or because they priced it incorrectly. It is because cash leaves the business immediately, while revenue returns weeks later. They can keep running loads and paying operating costs, but the revenue from those loads sits in accounts receivable. While expenses keep hitting the account and payments are still pending, the bank balance can reach zero before the larger checks arrive. When that happens, the truck stops moving, not because there is no freight, but because there is no cash available to operate. That is why starting with a real cash buffer is essential. For many 2026 startups, $20,000 to $30,000 in liquid cash is often treated as a practical minimum safety net. You do not have to be an accountant, but you do have to manage your cash like a business owner. Revenue looks good on paper, but cash flow is what keeps the truck moving. At Fleet Spark, we're a back office and capital partner for owner-operators and small fleets. We help you stay on top of your bookkeeping, cash flow, and working capital decisions so the numbers are clear before they create pressure. If you're ready to move forward, contact us at Fleet Spark. Thank you for watching, and I'll see you in the next video.